Hi there. There's a couple of products coming on the market now that are variations of an old lending product, I suppose you'd call it. And the one I want to focus on just very shortly today is invoice financing. For those of you who are not familiar with invoice financing, if you have customers that are paying you on 30-day terms, which may often end up being 45 or 60-day terms by the time they actually pay you. Invoice financing allows you to get a facility from a lender whereby the lender pays you generally around 80%, can be lower, but we'll use that percentage right now. 80% of the invoice value, generally within 24 hours or so. And then when the invoice is collected, you pay them back that 80% plus any interest and charges. But the benefit is for you is you get your cash up front as soon as you make the sale. And obviously, from a business perspective, if you've got people paying you on 30 to 60-day terms, or could even be a little bit longer, then that's one of the benefits of invoice financing. As a general rule, just as a little tip, be aware that invoice financing, after typically 90 days, the lender will say, look, if you haven't collected the money within 90 days, then you need to pay us back the money we've advanced to you, plus the interest and charges. So that's always something to bear in mind, that it's not an open-ended loan that goes forever. It does have a time frame attached to it, and it's generally 90 days. So that's one of the things with invoice financing you just need to be a little bit aware of. But the thing I wanted to focus on right now is the fact that they're becoming more prevalent in the marketplace, is invoice financing for specific invoices, so which you get to choose. So once the facility has been set up, you can actually choose a specific invoice that you want to have funded. So you might have, generally speaking, you might be happy with quite a few customers who are paying, let's say they're paying 7, 14, 21 days or something like that, or they're always pay on 30 days and they're never late. And your business can survive cash flow wise with that sort of payment term. But there might be 1 or 2 invoices that are either large, lumpy, or perhaps there's slightly a slower payment by the customer, and you want to do the deal, but you don't want to carry that extra cash flow burden for that longer period of time. So that's where specific invoice financing is quite prevalent. Now, it used to be, probably going back, I'd say, I've got to go back in my history now, but I'm going to call it 5 years ago. That's probably not accurate, but it'll give you an idea of time frame. There were some products coming on the market for the first time that were just specific invoice financing for specific invoices. Now that's being offered in a more available sense online as well, and I think that's an interesting change for the market. So if you've got a business which you think might be able to benefit from that sort of invoice financing as opposed to the broad brush invoice financing, then you look more than happy to have a chat to you about that particular type of product and what the alternatives might be for your business. Obviously, it depends on things like the business size, you've got the assets you've got available for security, both business and personal, that you might be able to put up to get money, and look at the best and most, or not the best, the most suitable loans for you and your business. One last thing around that, you might be thinking, so is there any other reason why I would go for specific invoice financing? And it's just one that's come top of mind to me as I'm talking to you now. Is look, if you've got a general facility, then obviously paying interest on every invoice that you're getting funded for. So if your business is, let's say 100% is based upon credit terms, and let's say you're turning over, we'll pick a number of $100,000 a month, so $1.2 million per annum. That 100,000, you're paying the amount that is out the door in terms of invoice financing, you're paying interest and charges on that. With specific invoice financing, of that 100,000 turnover, you might only need funding for $20,000 or $30,000 worth of invoices that either lumpy or the customer has a tendency to pay longer than 30 days. So that obviously is going to save you an interest cost. Now, probably my last comment in regard to all of this is, if you have a customer who you're concerned about, and therefore you think, you know what, I'll get the money now from invoice financing, just bear in mind the comment I made earlier that at the end of the day, you still have to pay the money back. And if the customer hasn't paid you and you have to pay it back, then it becomes effectively a loan that the business has to, or money the business has to find to repay that loan. And that's generally at about a 90-day term. So it doesn't mean you can get lax on your credit policies and think, you know what, we'll just get a deal with this customer because we can. You've still got to do your due diligence. You've still got to do all the things you should normally do, because at the end of the day, the business still has to operate commercially and in a way that's both profitable, viable, and sustainable for its future. So, with all that in mind, if you'd like to have a chat, more than happy to do so. Take care.